Yeah. And traditionally, they have been.
Oh, we have to start again. Okay. Is the sound working now? Maybe we should test that. Hello? Can they hear us? Okay, I think it's working now. Great. Let's just kick start it again. I'll give a quick overview. Thanks for tuning in today, everyone. We have Andy Lee with us, and we're going to be discussing equities and tokens. He's got an extensive background helping startups across Asia. He's worked at Uber, Mapbox, and he's founded a company called Sprout, focused on ESOP and ETOP allocation management outside of the US. So let's start with our first question.
Sure.
What's ESOP and why should people care?
So ESOP stands for Employee Share Option Plan or Stock Option Plan. They were invented out of the necessity for tax management out of the US, I'd say about 60, 70 years ago. They've become extremely popular in Silicon Valley as companies were growing and hiring and were short on cash. And so we're a really effective tool to compensate people as well as bringing people in and aligning interests and creating a extreme amount of wealth, especially in the dot-com era in 1.0 days. And you used to hear stories about the famous Google chef that his stock options at IPO were worth 26 million, or the Facebook mural artist that instead of receiving $50,000 payment to paint a wall, received stock options north of 200 million at IPO. So they have become famous for just extreme wealth creation. However, it's a bit of this risk return for a lot of employees where you're betting on your career with the right company, and if it hits, you can see some wild returns over an extended period of time. Companies also like it because it aligns interests and keeps the company and the employee engaged for a longer period of time. Typical length of time to claim all your employee share options at the offer is typically 3 to 4 years to receive that. So it's been a really interesting complement and an essential part of compensation packages in the US, and it's become extremely popular with the startup community that is growing outside of the US and particularly in Asia Pacific and in Hong Kong, Singapore.
Yeah, it's great. Honestly, a lot of founders are especially thinking about it these days when funding can be a little bit questionable. So on that note, what's ETOP now, and why should people care about ETOP? Am I saying it right?
ETOP, yeah, it's definitely been on the radar quietly, especially in the world of Web3, and I think I'm not a big fan of the word Web3, but it lets us, say that it includes crypto and blockchain companies. ETOP stands for Employee Token Ownership Plans. Most people don't call it ETOP. Most people know it as token vesting, which is, the word vesting is also an interesting word. It's basically a fancy word for saying, for representing distribution. The idea behind token vesting is very similar in terms of equity vesting, is that you don't get all your tokens or equity all at once. And it's sort of drip fed over an extended period of time. And so that, that distribution over time we call vesting. It has become quite popular in the Web3 world, where you would actually see many cases, especially with the big firms like Binance, Crypto.com, or popular kind of DAOs where people are exclusively paid in tokens. And if you are coming from a very traditional kind of background, you're probably thinking cash is king, and then equity comes into play, and it's to the sort of novice, it's a lot to digest. And then when you introduce tokens, I mean, I think it's another kind of dimension, but it really represents a future of compensation. And you're actually seeing a very interesting trend where Web3 companies are actually bypassing equity and going straight to tokens. And so you could actually be in a situation again where you're not actually paid in cash nor equity and exclusively tokens for your work. And so it's become quite a vital part of someone's compensation in the crypto blockchain space.
Okay, yeah. I mean, these are all important things we should consider when wanting to motivate our employees, because when they feel they can reap the benefits of growing the business, it's a lot more fruitful for everyone involved. So how does ESOP and ETOP work? Can you share with us what the differences are?
Sure. I guess the way to answer this question is kind of quickly go over how ESOP works, and then I'll highlight the differences on the ETOP. So bear with me for a few minutes while we kind of unpack this. Employee stock options come from what a company would designate as a pool for employees or advisors or other stakeholders that could receive future shares. So the common question I pose to people, or I highlight, is options are not shares in a company. Options are the right, but not the obligation to buy future shares. They do not exist yet, but need to be accounted for on a cap table, which we at Sprout also help companies and founders manage the entire kind of equity side of things. And so what happens is you take a look at your total outstanding shares and you create a pool of future shares. Typically you would start, based on statistics, around 5%, and then start growing that, and you can exceed 10%, 15% as you start raising subsequent rounds of financing. So this pool would be where you would allocate shares for employees. Let's just use employees as an example. So then what happens is there is an action that you take with the board in terms of creating the pool, creating the grants, and then providing those grants to an employee. Employee joins, and as part of their offer letter, they get, traditionally, here's your cash, here's your equity, and here are the rules to the stock option plan. Generally, without getting into too many details, there is a vesting mechanism. It's usually time-based, but it can also be milestone-based. But let's say best practice, 3 to 4 years of vesting. Typically, you do not get any shares vested in the first year, and they call that a cliff. That is to ensure that employee and company, are suited for each other. And so typically you would get a large percentage, if it's 4 years with 1 year cliff, then that's 25% on the anniversary, first year anniversary. Then you would get those shares, you have rights to it. And then over time, based on certain events, then the company would allow those employees to buy the shares, and that is exercising your right to buy the shares, and so that is known as exercise. So you have the grant, the vesting, and then the exercise. Once you are exercising and you buy the shares, then those shares are yours until you sell, and then you join what is known as the cap table, which is a list of all the shareholders and all the underlying information that comes with it. So that is how it works in general. The reason people come to us is because they're very difficult to track, especially if you're talking about 50 to 100 employees, and there's a lot of different vesting schedules and different timing. Everyone comes in at different periods of time. So in the beginning, most people use Excel spreadsheets to track it, but it just becomes very difficult. And then administrative-wise, HR teams are having a difficult time to track and manage. So then software really comes into play. What we do at Sprout is also help coach, mentor, and help people think about and design what's the right plan. There is no perfect plan or same plan that fits everybody. So we help kind of listen and provide some advice. I'll pause there and then transition to the token side. So ETOP side, there is the notion of this pool, but it doesn't really take any legal form. Oftentimes it can be from an existing wallet or an allocation. Typically it comes from what we call the treasury wallet. Mm-hmm. So the treasury wallet holds all your tokens for any organization. And similar to ESOP, there is a vesting. Now the biggest difference is there's no exercise. Once they vest, they are yours to do whatever you want with it. Right. And so, that's part of the decentralization of these assets. And the way they are transferred to you is also quite interesting. Traditionally, they have, as modern or as technologically advanced, as people talk about the blockchain and all the technology around it, the dirty little secret around token vesting is that it's an extremely manual process. I've heard stories, I won't say which very large exchange has a person in finance who's in charge of manually distributing tokens from the treasury wallet into each and every individual in the company. Oh, he does this twice a month. Wow. And it is incredibly manual. So if you're familiar with, holding, Bitcoin or Ethereum on these little ledgers, imagine this poor individual is transferring using the ledger, moving, tokens from one token to another one, right? And that's all on the basis, again, of Excel. Yeah. Wow. So it's still a very new process. Yeah. And so what people in the last few years have tried to do is create what is known as smart contracts. Smart contracts basically is a very short kind of line of code, hopefully. It sets some rules and basically says, on this certain time, you will receive X amount of tokens as part of vesting. You could set it up that way, but not everyone does it because the blockchain is very immutable. And so when you put something in there, oftentimes, you have to go back and create, another smart contract or another set of scenarios to kind of cancel out or to stop that transaction from happening. So people still prefer to do it sort of the old-fashioned way. And so that transfer over can occur in two different ways. One is we call it an airdrop, right? Which is I push it over to you. And the big difference, one of the additional differences between ESOP and ETOP is ESOP is all kind of theoretically happening, where there's actually no action taken until you buy the shares and then you're issued a share certificate and the company secretary gets involved. Mm-hmm. In the case of tokens, there's actual real execution that's happening. And so when you are transferring, for people that are familiar, when you're transferring from a treasury wallet to another wallet, you have to pay a transfer fee called a gas fee. Yeah. And it gets pretty expensive. And so there's another mechanic involved, which involves the action they call claiming, which is it's more of a pulling mechanism, and employees would then claim the tokens, and thereby they pay for the gas fees. Okay. So there's a difference. So you actually have real transactions and real fees, and there's an additional cost of doing this, which again, current situation, aside, it's been very lucrative for the past 5 years in this space. So it's a very kind of emerging opportunity, and I would come back and say the biggest difference also from an employee standpoint is the mindset and the understanding around it. ESOP is a bit difficult to kind of understand unless you've been at a bunch of startups and received that, the grants and exercise and that exit. And if you haven't, then it still remains a bit of a mystery. And so for the current generation of people in Web3, it's a younger crowd, Gen Y, Gen Z. They totally get tokens. So from a operational standpoint and a management standpoint, it's much easier to communicate as part of a compensation package that they get tokens. And you don't have to explain tokens to young people. They probably understand it better than me. Versus explaining the value of a stock option. Why should I care? Why, why does it matter? In places like Hong Kong, where cost of living is not the cheapest, people are very keenly sensitive to liquidity, right? So cash remains king in a lot of areas, but tokens are actually a new, form of an asset that, if you think about sort of this, if you think about cash as immediate, and you think about equity in terms of time horizon, risk return is at the far end. It takes longer to get, but you get way more potential return on equity. Tokens actually sits in the middle in terms of its liquidity and its risk return. Although right now risk is pretty risky, but the liquidity part is it's much more liquid because again you can sell it immediately. You can off ramp it, turning into fiat and then pay your bills versus equity.
Yeah, that's very informative. It's in literal terms, I would have thought they were quite similar, but there's so much technicalities behind it that make it slightly different, and ETOP being favorable if you have that capabilities of doing so.
It's not the easiest, but and it's still very manual. So that's why Sprout launched a new product called Folium, which, in addition to helping companies tag and track and monitor token vesting, we actually can help organizations manage all the related parties, not just the employees. And so, not to shamelessly plug what we're doing, but we build a product.
That's why we're here to hear from you.
We build a product to help organizations better track what I call the sphere of influence. What we've seen in the marketplace is there's a huge focus on the retail investor side of tokens, and because they occupy and own the largest percentage of any given token. However, they're not the ones steering the ship, right? They're not the ones determining what protocols or what projects, the direction that these organizations are heading. So you want to, in addition to tag and track and manage ETOP, you also want to know, investors, the ownership percentages. You want to know if the founders are going to flip, after an ICO, initial coin offering, or is the investors going to flip? So it's sort of this this platform that enables transparency, accountability, and governance. So we're really excited about being able to service organizations not only on the token vesting side, but the token management overall.
So with that in mind, what are some important considerations for founders or for employers?
I think in general, ESOP and ETOP, you need to figure out how much to give people, right? That's a common question. And the common misconception is to look at it in terms of percentage of ownership, and then try to compare, what is industry standard. I think that is more of the end result than how you should really kind of do this. So I think about it in a top-down and a bottom-up perspective. Ultimately, how much you give someone is based on the value of money that you would like to compensate someone. So you start with that idea. Top-down means I take all my available shares in the pool and I divide it by all the possible employees that could get it, present and future. And you get sort of a ballpark after that. You basically say, look, if I had 100 shares and I had 10 people, then everyone gets 10 shares, right?
Mm-hmm.
Does that make sense? Probably not. It's going to be more of like a pyramid where seniors get more, senior executives get more, middle management gets a little less, and then juniors get the least, right? Um, and and then the bottoms up is where I help a lot of companies and founders kind of figure out how much to give someone. So the way I think about it is, if you're giving other assets like cash, um, and let's say you are a startup and you're trying to figure out how much equity to give somebody, that's really just your shortfall in terms of the cash you're not meeting, right? So I think about like some market value of this person, and I sometimes use a big bank like HSBC. Like, what is the standard of a big corporation that would pay someone 100% cash? And then because we don't live in that unlimited resources type scenario for most startups, then let's say you can only pay them 70% of that. Then that 30% you would provide in equity. Mm-hmm. And that's the same idea with tokens. Now, tokens is a little tricky because they are decentralized and they're actively trading. So in some big exchanges for employee compensation, they try to take an average, like a previous 12-month average. And this is really interesting. So they take a previous 12-month average, and then they give you sort of this average price. Maybe it's weighted, unweighted, but they'll give you that average price. And so let's say there is some component of cash, and then the shortfall will then be divided by the average price per token. Okay. And then that is the amount of tokens you get on vesting every month. Yeah. If you have zero cash, then it's basically divided by your market value. Okay. Yeah. That's the big one where people say how much. The other one is people ask like how does that, like, how long should it vest? It really depends on where you are in your stages. Like I said, best practice is 3 to 4 years. Mm-hmm. And then should we have a cliff? I think cliffs are more common in with equity. Yeah. But tokens, if you're exclusively paying in tokens, you have to give it right away, right? Yeah,
that's fair. So with that in mind, if I'm an employer, or not even an employer, let's say I run a project, mm-hmm. Do I need to be an official company in order to start granting tokens?
No, that's the beauty. And so you could be a project team like a DAO. You could be, you could start a game. You could be a little game team, like a sub game team of a big gaming company. Right. And there's a bunch of examples where there's a lot of game makers are making multiple games, and they have their own tokens, and it's entering, and now they're calling it GameFi, right? Yeah. So you can be a sub team that has their own set of tokens that could be used for compensation, as well as you might even have sub investors where investors come in and say, well, I'm only interested in this one game or this one project. But you need to track like who has that influence.
Right. And how about for employees? What's important for employees to consider?
Yeah, so on the equity side, you want to know, and as you're presented an offer, you want to know what is the current share price, mm-hmm. Where is it headed, and this is an opportunity actually for employers to sell the dream, right? Mm-hmm. What is the value of my equity at 2x, 5x, 10x? Because the extreme risk return and time horizon involved with equity. So you have to explain, and you want to know how it works. What's the vesting? Is there a cliff? How long is it? And if you are increasingly more senior in your career, you want to know percentage of ownership on a we call it fully diluted basis. So you take all your outstanding shares and anything that can convert into shares, you add that together, and we call that fully diluted. That also works the same for tokens. So the notion of ownership percentage is really important in equity because you want to know where you are, because the company will continue to issue shares over time. And that math is just, will naturally generate a lower a decreasing percentage of ownership. We call that dilution. But I don't think of it as I'm losing a percentage of ownership. You want to look at, your slice of the pie. Is that pie getting bigger? Is it getting more valuable? And on the equity side, you want to know, is this a company that I want to invest my career for the next 4 or 5 years into the business? Or am I better off going to get a job that pays cash, because you're making a big bet. And so not everybody has the luxury of time, and they have a lot of other kind of pressures in life, bills to pay.
Mm-hmm.
On the token side, it's similar. How much am I getting? What is it worth, right? And again, is this token going to be valuable, or is it going to collapse? And so there are some places like Binance, Huobi, that exclusively pay in tokens, and so you really need to believe in this, that this thing is going to continue to grow, and they're often subject to a lot of fluctuations. So one thing to consider that's very different from tokens or from equity is that let's go back to that example where that poor finance person is paying twice a month. Let's say your vesting is supposed to be on the 15th, but let's say this person pays out on the 5th and the 25th or whatever, 20th, right? So you're sort of in between.
Mm-hmm.
You get your tokens on the 5th. It's priced on the 5th.
Right.
And technically speaking, you should be putting together your compensation report and submitting it to the IRD or the tax authorities based on the day you receive your tokens, right? But what happens the next day and it collapses?
Mm-hmm.
You still have to pay the tax on
Wow.
the 5th, right? And let's say it just continues to drop until that day that you're supposed to be vesting. What do? Well, I'm sorry, too bad. You got it on this date, and then now it's only worth, it dropped 20%, right? And now you end up paying more tax than you really think you deserve to. So then that's where for Sprout and on our product portfolio, we're trying to solve that and help people and help organizations pay out on the date, accurately, so that you are paying your share of taxes, not based on the convenience of a company, but in actuality.
Okay. Wow. So you're still getting taxed because you're receiving that asset
On that day.
Even if you haven't realized those gains.
Yeah. Well, you got it. Yeah, and then you're not supposed to get it that early, right? And then it drops.
Yeah.
Right. So then now you're holding an asset that or maybe it comes back, right? So,
yeah.
But it's a roller coaster, versus employee share options where the price doesn't really fluctuate that much. Right. The price may move maybe once a year, based on the board might do a fair market value assessment, or they will do they might do a fundraise, and then an investor will come around and say, well, I value your business at some amount, and so the price per share moves. But it doesn't move that much.
Okay. Yeah, that's a very important point to consider, and those that are really looking into ETOP, you should look into Sprout for some of these management tools. So you have a lot of experience doing this. I know you've been advising companies for a long time. What are some best practices that you can advise our entrepreneurs listening to manage ESOP and ETOP, and what terms should they set forth for their employees?
Right. So I've sort of mentioned a bit of the kind of best practices already. I would say best practice, start small. You don't need like a 20% ESOP pool, right? You don't need to over dilute yourself. It's actually a mathematical game often played by the investors. They're incentivized to force entrepreneurs to create a share option pool, because when you are reserving future shares for employees, you have basically put your stake in the ground, and that means to them it's what we call an anti-dilutive to have a share option plan in place, because they will issue shares from that pool versus issuing new shares. So if I bought 100 shares, and I'm an investor and I bought 20 shares, you know, those 10 shares would be given out to employees, so I still own that same percentage. But let's say all those shares were given out, and then the company will have to issue more shares and create another pool or extend the pool, then my ownership will drop, right? And that's and that makes things a little more, it's not as palatable to an investor. So what happens is an investor might present you with a term sheet and say, I want you to create or extend your stock option pool, which then mathematically will lower the stock price per share, because your share numbers, your denominator increases, and then your price per share goes down. And then let's say someone tells you to do 20% and you've only given out 15% of that 20%. You have the remaining 5%, and then at liquidation or an exit, those 5% that you haven't given out, they get canceled, right?
Oh.
Which then means your denominator decreases.
Okay.
And your price per share artificially increases.
Right.
So investors get a nice bump in the beginning. They get a discount at the beginning because you created or expanded your ESOP pool. And at the end, they get an artificial bump at the end. It's math. So a lot of founders don't realize that this game is being played. Yeah. So I tell founders to, be very deliberate, know how many shares you want to give to employees, including with your crystal ball, future employees and how much they should get. And once you put that together, that should be sort of the ballpark for your pool versus throwing out a big number, right?
Yeah.
In tokens, you also need to think about the tokenomics, right? Especially if it's your own tokens. If you continue to issue tokens, you get, sort of like this kind of Econ 101 concept of it's like printing money, right? It's like printing, you continue to print money, you're gonna have inflation because your currency and your circulation continues to increase, and then you'll have to continue to manage that economics unless you do things, and I know Binance will regularly what they call burn their tokens to reduce the circulation, to keep it to keep that tokenomics kind of reasonable. So as you are thinking about giving tokens to employees and to community and for marketing or investors, think about what is the current circulation, fully diluted circulation, where is it headed down the road, because there are things that are off chain that people don't think about, like simple agreements for future tokens, like a safe note, but for tokens, right? Convertible notes. They give you cash or stable coins up front, and then you have yet to issue tokens. And when you do that, then there's dilution, right? And so you need to think about, is this going to inflate circulation, and will I just have this runaway, circulation pool? So there's a lot more kind of math there that probably won't have time to cover. But that's a whole nother topic on tokenomics.
Yeah, it sounds like there's a lot of technical considerations that is really overwhelming for an early stage entrepreneur to think about, when sounds like some of these considerations have to be done up front when you're allocating your stock option pool to begin with.
Yeah, I mean, it's not something founders think they need. It's sort of like you don't know what you don't know. And but I think in the equity side, founders are becoming more aware at an earlier stage. And it's great. A lot of them come to us earlier on, and then we help them design and create the plan and help them launch it, and then use Sprout to kind of track everything. I think in the token world, it's still a bit of the Wild Wild West, right? You have information managed on Excel, on some contracts, on some napkins, on some promises, on some emails, meanwhile, meanwhile, everyone's so focused on chain, but then there's just a whole world of off chain that I think oftentimes we get so infatuated with all this technology that when you look behind the curtain for a lot of these Web3 companies, it's just a wasteland of disorganization.
Right.
And the biggest,
Interesting.
it's very interesting, and the
Yeah.
biggest irony that we've discovered, and which is why we also exist, is Web3 companies are not only raising money off tokens, but they turn around and raise money on equity.
Yeah.
For either fiat or stable coins. And then where's the smart money going? They're actually going and buying your equity.
Mm-hmm.
So you actually need both, and you need to be able to track both.
Right.
And you need to be able to track who are your shareholders, because they actually own your treasury tokens.
Yeah.
Right. So there is a direct relationship. And so it made sense for us to kind of expand into this space, because we just feel that Web3 companies are going to increasingly, they may not know it yet, but they need to increasingly create a lot more governance and need more digital tools. As these engineers are bringing on non-technical people, they're going to show up on day one and say, all right, what are we using to manage our information?
Yeah.
And it's going to be quite shocking when the HR person says, I have nothing. I have an Excel spreadsheet that it's been barely managed. Right. And how am I going to airdrop this many people, and who's going to do it?
Yeah.
Poor finance person is doing it, right?
Yeah, and there's a lot of room for error in that regard too.
Yeah, and it's just, I can't even imagine that role of that person, but there's dozens of people doing this,
Yeah.
right now.
So, with that in mind, how do I determine whether or not to compensate with equities or tokens? How would you advise?
I actually think the future will have all three: cash, equity, and tokens. I think having optionality as a founder or as an employer is great. We've actually helped one of our clients figure out put together a package where employees have a choice of 100% equity, 100% tokens, or 50-50. Mm-hmm. I think that's a great start. Mm-hmm. And with Sprout, you can probably figure out some curve where it's not just three choices; it could be some linear relationship.
Yeah.
I think that the future could also be a world where you don't necessarily need to mint your own coins. You could easily just pay people in Ethereum or Bitcoin. Mm-hmm. And if I was someone that's planning to do that, I would probably buy some now because they're so cheap, right? And over time, I think the value would catch up with the current environment. But right now is a good time to stock up. I don't know where the bottom is, so don't. This is not any financial advice, so please don't yell at me. But you don't necessarily need to mint your own coins to compensate your team. You can just pay them in Bitcoin or Ethereum or something.
Okay, and that would still need some type of.
You would still need to be able to track it and track the vesting and generate reports and again, this is where we built a lot of tools, administrative tools. To help teams manage these assets.
Okay, yeah, that's very helpful. And actually, at the end of this session, we're going to share a link where you can schedule a meeting with one of Andy's team members from Sprout, and they can give you some advice, and you can ask them any questions you might have around ESOP and ETOP as well. So, how does a company's fundraising and equity or tokens impact their ESOP or ETOP grants?
Yeah, so I've kind of talked a little bit about it earlier. So with every subsequent round I'll talk on the equity side, subsequent round on equity side, investors might come back and say, how are you doing on your pool? I think you should increase your shares, increase the pool. And so there's a few features happening. One is, as an employee, you're just going to, dilution is just a fact of life. It's just basically math. As more shares are issued to investors or other people, you're just going to see a smaller percentage of ownership. But again, don't focus on that piece. Focus on what is the shares worth and how many do you have. And when do you have access to it, and when can you sell it, right? When is the company going public or getting sold? So I would focus a bit on that. On the token side, obviously, let's say you're an early project and you haven't issued it yet, then as an employee, you want to know, like, when am I going to get it, right? When is it going to get minted and rolled out, and how am I going to get it? I would definitely factor in the gas fees and the tax implications. When am I getting these tokens, and who's tracking it? How can I track it? How do I know if my employer missed the payment?
Yeah.
And again, this is where you need something more than Excel, right? To be able to track it. And so again, what we represent is accountability, right? Accountability between the team, the administrators, the investors, and the founders. So everyone is, it can be transparent depending on the settings that you do, but it allows you to have the ability to know where you stand, right? And I think that's really important. And then there's some really fascinating information if you are able to read the blockchain. But again, not everyone can read a blockchain, right? So having all that translated into sort of, layman information, I think is also important for team members. I would be remiss if I didn't mention there's also a whole world of DAOs where they're not necessarily a company, they're just a group of people trying to solve a problem, and when you contribute to that DAO, you get coins, right? And those coins often also have some governance feature, like a vote, right? And sometimes they get really complex, like a super vote, because I'm a project team member versus I'm just a contributor in the community. So it's really important to understand, if you're a token holder in a DAO, like, what is your voting power? Do you have any votes? Is it less than the other people? Do you have significant influence if you're contributing but not part of the core team, right? And it can also work back and forth too. As a DAO organization, you want to know, how big is the retail side? Can they overpower the organizational team and force the organization to do something that isn't right?
Right.
A famous example happened a couple of weeks ago where the organization put to a vote whether or not to kick out an existing investor who put in money for future tokens, right? Signed a contract and gave the money, and the organization thought it was okay to put to a vote to kick out this investor or not. And then, of course, it was poorly presented and poorly represented, and then everyone voted majority to kick out the investor.
Oh my goodness.
Not knowing that you have, contractual obligations between the organization and an investor. Yeah. Right? So how do you unwind that?
Yeah,
it's a little crazy.
Yeah.
Right? So understanding where the votes are, understanding where the sphere of influence is, and understanding, who are your constituents, is very important. So again, token management is something we're really hoping to bring to this kind of brave new world.
Yeah, there's so much, like there's voting rights and all these other powers that come with owning equity, but also tokens as well. And with DAOs, with everything being decentralized and really group voting is a huge thing, there's a lot of other instances where it can go awry. So
yeah. So I mean, we built all this for Sprout on the equity side, including a cap table by voting power. So it's very easy for us to kind of port that over to support a DAO, and then to also extend NFTs, non-fungible tokens, also need to be tracked. Yeah. Especially when they have some type of smart contract or royalty payment assigned to it, and you want to be able to, as a creator, business manager, track the ownership and the movement of, the Bored Ape or whatever, that people are buying, or
how much royalties you get in return
or,
for that.
and then just adding context to the blockchain, right? Because the blockchain will only tell you so much. They won't tell you the owner of the owner of this wallet. They won't tell you why this thing happened. Maybe not, right? And you can't be digging through lines of code to like find your block and find your piece. Right?
Yeah, that's true. I have one last question for you before we try to see if there's any from the audience. But I know you touched on this a little bit earlier. You talked about taxation just a little bit, but maybe we can delve into it a little more. How is ESOP and ETOP taxed? What's involved, and how might they be different?
Sure. So I'll again preface, I'm not a lawyer, I'm not an accountant, I'm not a tax lawyer, so do not take this as definitive advice, but I will share from a practitioner standpoint.
Perfect.
In general, on ESOP, you are taxed at what the accountants call the acquisition. When you acquire value from the company, that is a tax event. For places like Hong Kong and Singapore and the United States, that event is at exercise. So as you are vesting, you haven't done anything yet. Those just are your rights. But when you buy those shares and you exercise your rights, that's when you have received compensation, which is why I've always argued that share options is part of compensation. It's not a benefit like insurance, right? You are taxed on this piece. And if you are fortunate to be in Hong Kong, Singapore, that's it. That's your only tax event. Because once you acquire those shares, you can sell them, let's say on a stock exchange, and there's no capital gains, right? Unlike the U.S. or other markets like China. In some markets like China and in Indonesia, you are taxed at vesting.
Okay.
And you're taxed at an earlier point. So there are some, pros and cons in terms of as a manager or as an employee, you need to think about in terms of should I join this company? Do I believe in this company? Because if I am vesting in China or Indonesia, even though I don't buy the shares, I still have to pay the tax on this, right? And some of it is often self-reporting in emerging markets versus, I think employees here, we have to submit, employer returns and delineate very carefully how much someone got. In the case for ETOP, token vesting, you pay tax right at that moment you receive it.
Okay.
And then again, depends on what market you're in. Capital gains are generally not assessed on crypto, but you never know. You never know in this market. Right now, I'd say you're okay unless you're an American. Maybe the laws will change down the road. So there's a bit of uncertainty. So I'd say the biggest piece is there is this burden on the individual in tokens to report.
Okay.
Because again, if I'm thinking I'm like the lone HR person at a crypto or blockchain company, they may not have the skills or the knowledge to put together an employer return to tell people. So I think there's still a bit of this self-reporting.
Yeah.
So again, that's where Sprout comes in, and we can help generate reports for employers as well as employees to see, all the transactions that have taken place on chain.
Yeah, that's very helpful, especially as this space is so new and ever evolving. To make sure you're not skirting anything that might now be a regulation or a law, it's helpful to have experts like your team constantly updating your system, so that we're doing the right thing. We're not going to be caught by the government later on something we didn't realize.
No, and I think regulations is a good thing, right? It brings things to the light. It brings an industry like Web3 more onto the mainstream kind of market, and the more clarity, transparency, and rules around this makes it easier for also employees and employers to operate.
Yeah. Well, thank you so much. What we're going to do today after this session, we'll share a link out. And again, for those of you who are interested in speaking with Andy's team at Sprout around ESOP management, ETOP, how to get started, you can reach out to them over there and they'd be happy to share more information with you. Thank you so much, Andy, for your time. It's been so educational learning about this space and so, eye-opening to think about all these minor things that, or actually major things that are technicalities that we may not have even realized. So I think a lot of our teams would have found this very helpful today. Thank you so much.
It was my pleasure. Thanks for having me.
Great. Thank you.